In today's video, we will learn 9 money habits preventing you from saving. Today, many Americans find it challenging to save money because there are so many tempting ways to spend it. With just a few taps on the phone, you can buy almost anything you want, and there always seems to be something new to spend money on. In fact, according to Bankrate's recent emergency fund report, only 43% of people have enough savings to cover a $1,000 emergency expense, which is concerning. However, the good news is that there are several ways to boost your savings. The first step is to recognize the habits that stop you from saving and devise a plan to change them. So, if you're unsure about the specific habits affecting your ability to save, worry not. This video will outline 9 everyday money habits and strategies to break free from them. So, without delay, let's delve right in. Number 9, not investing in yourself. This means missing out on opportunities for personal and professional growth that could increase income and success. If you solely focus on saving money without considering investing in your development, you might limit your potential to earn more. Investing in yourself involves taking courses, learning new skills, attending workshops or events, and broadening your knowledge through reading. Doing these things enhances your abilities and expertise, leading to better job prospects, promotions, or opportunities for higher paying positions. It's like planting seeds for your future. Saving money is essential, but investing in your skills and knowledge is equally crucial because it can significantly increase your earning potential over time. The more you invest in yourself, the more valuable you become in the job market or your business ventures. Number 8, relying on cash advances. Cash advances, such as early payday loans or buy now and pay later services, seem like a quick fix when you're tight on money. However, using them frequently can trap you in a cycle of debt that's tough to escape. These advances let you spend money you don't have at the moment. They can feel like an easy solution, but there's a catch. You'll eventually have to pay back the advance, often with extra fees attached. For instance, overdraft fees can be pretty hefty, averaging nearly $30 per transaction based on recent surveys. The problem is that these advances create an illusion of free money, but they add to your financial burdens over time. You might struggle to repay them, leading to even more debt and increased financial stress. So, rather than relying on these advances, exploring alternative ways to manage your expenses is better. Building an emergency fund or taking on a side job can provide a safety net for unexpected expenses. If overdrawing your account is a recurring problem, opting out of overdraft protection can help avoid those high fees and encourage better budgeting habits. Number 7, feeling the need to keep up. It's common to feel the urge to match the lifestyles of those around us, especially friends and family. Seeing them upgrade their possessions or experiences can make us want to do the same. However, this can lead to a financial trap where we make purchases solely to keep up with others rather than considering our financial situation. It becomes problematic when we start making financial decisions based on comparison rather than personal financial stability. Just because someone we know has bought a new car or other flashy items doesn't mean it's a financially sound decision for us. It's crucial to remember that everyone has their financial journey, and appearances can often be deceiving. While someone might seem able to afford a luxurious lifestyle, they might rely on credit cards or other forms of debt to sustain it. So instead of mindlessly following others, focusing on your financial goals and capabilities is wiser. Evaluate your needs versus wants, prioritize saving, and make informed, responsible spending decisions based on your circumstances to avoid unnecessary debt. Number 6, not automating your savings. When you rely on saving what's left after spending, saving a substantial amount becomes challenging. This is because expenses tend to expand to consume whatever funds are available, leaving little or nothing behind for savings. Instead, a more effective approach is to prioritize savings before spending. By automating your savings, you're essentially flipping the sequence. You save first and then spend what's left. This ensures that a portion of your income is set aside for savings every time you get paid. Automating withdrawals from your paycheck or bank account removes the need for active effort. With this system, you don't have to decide how much to save consciously. It's done automatically. This consistent approach fosters a saving routine, guaranteeing regular contributions toward your goals without relying on leftover funds. Prioritizing savings before discretionary spending helps instill a strong savings habit and moves you closer to your financial objectives. Number 5, not setting specific savings goals. Having clear and specific savings goals is like having a map for your financial journey. These goals help you know how much to save and why you're saving. Without specific savings goals, it's easy to lose track of how much you should save regularly and the strategies needed to reach those goals. Changing this habit is vital because it forms the basis for all other effective savings habits. A great starting point is to sit down and outline your savings goals. These could be short-term, like saving for a house down payment, or long-term, such as planning for retirement. Defining these goals gives you clarity and direction, making it easier to incorporate them into your budget and set a target date for achieving them. Once you've set clear goals and attached a timeline, you can calculate the monthly savings needed to reach them within your desired timeframes. This approach gives your savings a clear purpose, helping you stay motivated and focused on consistently setting aside the necessary funds. Furthermore, having specific savings goals guides your financial decisions and ensures you actively work towards achieving milestones that matter to you. Number 4, letting debt accumulate. Recent data on debt in the US paints a concerning picture, revealing that many households carry significant financial burdens like personal loans, student loans, and credit card balances. What's more troubling is that most people are making only minimum payments on these debts, allowing them to balloon with accumulating interest. This prolongs the struggle to become debt-free and hinders the ability to save money. To break free from this cycle, it's crucial to confront it head-on. Begin by creating a detailed list of all your debts, including their interest rates and due dates. Then, prioritize payments using either the avalanche or snowball method. The avalanche method targets high-interest debts first, ultimately saving more money by reducing overall interest payments in the long term. On the other hand, the snowball method concentrates on clearing smaller balances first. Ensure you choose what works for you. For those grappling with federal student loan debt, devising a strategy for timely payments is essential. Federal loan borrowers can access various income-driven repayment plans, which ease the burden by adjusting monthly payments according to income, potentially making them more manageable. Number 3, overspending on non-essential items. This habit often happens without us noticing, accumulating expenses on things we don't need. For those who frequently find themselves tempted while window shopping, consider this approach to break the pattern. When you spot a non-essential item you're motivated to buy, jot it down on paper or in your phone's notes, and wait a few days before making the purchase. With time, you might discover that the desire for that item fades, allowing you to save the money you would have spent. Another helpful tactic is to create a shopping list before heading out to shop. With a list, avoiding getting sidetracked by things you don't need while at the store is easier. Essentially, it's about practicing financial discipline. The goal is to have more control over how you spend money by consciously deciding where it goes. Eventually, this can lead to more mindful spending habits and improved financial management. Number 2, having no emergency fund. Bankrate's 2023 Emergency Fund Report highlights that 57% of US adults aren't comfortable with their emergency savings. Many aren't putting money aside for emergencies. Instead, they focus on different savings goals, leaving their emergency funds low. Though higher inflation is making budgets tighter, it's still crucial to prioritize setting money aside for emergencies. These funds are a safety net, allowing you to cover unexpected expenses without accumulating more debt through credit cards or loans. To start building an emergency fund, review your budget's different categories and identify areas where you can make slight changes to redirect more money towards savings. Consider keeping these savings in an online account, as they often offer higher interest rates than traditional accounts. This move allows your money to grow more effectively over time. Even though the difference in interest rates might appear small, it can significantly impact the long-term growth of your emergency fund. Number 1, not planning ahead with a budget. Think of a budget as your financial GPS. It's a tool that helps you keep track of your money, ensuring you know where it's going and where it should go. Without a budget, it's easy for you to veer off course financially. What do I mean? Tracking expenses allows you to understand your spending patterns, while monitoring savings progress helps you work towards your financial goals, whether for emergencies, a vacation, or future investments. With a budget, you gain clarity on what you can afford and what might lead to negative spending habits if unchecked. When creating a budget, ensure you account for your wants, needs, and savings. The 50-30-20 rule is a popular budgeting method suggesting that 50% of your income covers necessities like housing, utilities, and groceries. 30% goes towards wants, such as entertainment, dining out, or non-essential purchases, and the remaining 20% is earmarked for savings or paying off debts. This helps you prioritize spending and savings in a balanced way. Lastly, it's wise to slightly underestimate your monthly income to grant more flexibility in spending and avoid feeling financially tight at end month. Remember, how you handle your money is heavily influenced by your habits. Identifying these habits is the first step to changing how you manage your finances. It's not about being perfect with money, but about learning from mistakes and steadily improving. By intentionally embracing smarter money habits, you can actively steer toward making informed choices and growing financially.